Welcome to The Explainer. Today, we're cutting through the daily market noise and stock fluctuations to really unpack Netflix's dense Q2 2026 earnings report. Our goal? To evaluate their enduring business fundamentals. If you're a long-term investor, this is exactly the kind of deep dive you need to understand where this company is truly headed over the next few years.
Here's our roadmap for today. We'll start with the financial foundation, look at how they're winning the engagement battle, dive into their Gen AI advantage, explore how they're monetizing that massive audience, and wrap up with cash flow and capital returns.
All right, part one, the financial foundation. Let's look at those Q2 top-line results.
Diving straight into the consolidated statements of operations, we're seeing some rock-solid top-line execution. Q2 revenue hit $12.6 billion, and operating margins actually expanded to an impressive 33.4%, which came in slightly ahead of their own internal forecasts.
That $12.6 billion, that translates to a 13% year-over-year revenue growth. But honestly, the engine behind this is what's really fascinating. It's definitely not a one-trick pony. We're looking at a trifecta here. Strong membership growth, strategic global pricing power, and an ad revenue stream that is just rapidly scaling up.
And this consistent double-digit growth trajectory, especially coming off high growth in late 2025 and early 2026, keeps them firmly on track. This kind of consistency is exactly what gives management the confidence to narrow their full-year 2026 revenue forecast to a very healthy $51 to $51.4 billion.
Moving on to part two, winning the engagement battle. This focuses on Netflix's first strategic pillar, entertainment value. Now, management made a statement recently that is an absolutely crucial signal for long-term investors. They said, "We know not all hours are equal. Time spent is just one aspect of strong engagement. Quality and variety also matter." This tells us leadership is laser-focused on content return on investment rather than just blindly chasing vanity metrics or raw screen time.
To back up that push for quality and variety, Netflix is aggressively widening its moat across some wildly diverse verticals. They're jumping into live programming with the NFL and MLB. They're scaling cloud games where, get this, their kids app Playground has seen a massive 600% jump in engagement. They're also expanding into video podcasts with heavy hitters like iHeartMedia. And of course, their core business of global hits is still firing on all cylinders, with Swapped already on track to be their second most viewed animated film ever.
So the real kicker regarding those new NFL and MLB deals is the sheer efficiency of the strategy. Live programming is only going to account for about 5% of their total content spend in 2026. Yet, historically speaking, live events have driven 6 of the top 10 new member sign-up days over the last 5 years. I mean, that is just a phenomenal return on capital.
But with all this high-quality output, live sports, and gaming expansion, you might be asking yourself a pretty logical question. How on earth does Netflix scale production to this level while actually expanding their operating margins?
Well, that brings us to part three, the Gen AI advantage, and how they're leveraging technology for margin expansion.
The adoption rate we're seeing here is literally staggering. Just this year alone, in 2026, Gen AI workflows have already been utilized in roughly 300 of their titles. They're actively leaning on these tools to push out higher quality content way faster and at a significantly lower cost than traditional methods.
This is creating a compounding tech advantage across their entire ecosystem. For you and me at home, it means highly personalized title discovery using large language models and voice search. For the creators, it's a massive boost in post-production efficiency. Think generating complex historical crowd sequences or world building for international productions like Glory. And on the business side of things, it means fully automating their ad campaign optimizations.
Which segues perfectly into part 4, monetizing the audience. Let's talk ad scaling and strategic reporting.
Right now, Netflix is effectively running this highly optimized dual-engine model. On one hand, you have their traditional subscriptions, where they just keep seamlessly flexing their pricing power in major markets like the US and Mexico without skipping a beat. On the other hand, they're rapidly scaling up their ad-supported tier. They're doing this by opening up programmatic access for smaller buyers this summer and really leaning into the massive advertiser demand for all those live events we talked about. And this dual-engine approach is proving to be incredibly lucrative. Management is projecting their ad revenue will roughly double to a staggering $3 billion for 2026. So yeah, this isn't just some side project anymore. Advertising is now a core pillar of their financial thesis. Interestingly, to make sure Wall Street and investors stay laser-focused on these financial growth metrics, Netflix is strategically shifting how they report.
Starting in 2027, they're moving their biannual What We Watched engagement report to an annual release. They basically want the market's attention exactly where it belongs, on revenue and operating profit.
Finally, we reach Part 5, Cash Flow and Capital Returns, or how they're rewarding the long-term investor.
Looking directly at the consolidated statements of cash flows, the underlying cash generation is just phenomenal. Even with their massive investments in content and new tech, the company still expects to generate approximately $12.5 billion in free cash flow for the full year.
So how exactly are they allocating that mountain of capital? Well, they executed a massive $4.7 billion in stock buybacks in Q2 alone. To put that into historical context, that is their largest single quarter of share repurchases ever. They are buying back their own business with absolute conviction.
And thanks to a newly authorized expansion from the board of directors this past April, they're sitting on an absolute war chest of over $27.1 billion in remaining capacity. To put that crazy number in perspective, that's roughly the GDP of Iceland, and it's authorized entirely to return excess cash directly to you, the shareholders, effectively shrinking the share count and boosting long-term value.
So as we wrap up today's explainer, I want to leave you with this final thought. When you look at their expanding 31.5% margins, a projected $12.5 billion in free cash flow, massive capital returns, and these tech-driven cost efficiencies that are honestly just beginning to scale, just how wide is Netflix's long-term moat? It's a fascinating question for anyone looking at the fundamental strength of this business. Thanks for joining me, and keep your focus on those fundamentals.